And so it's that constant process of, spoofing punctuated by these big short covering rallies. And again, this is that distribution. You got the OGs selling into it for the first time, which is good. We want that. We got fewer new buyers. We still have some, but we have fewer new buyers. And we've got the constant downward pressure from the futures market that's kind of capping prices. So, I think we're going to be stuck in a kind of squishy zone for a while. I don't think we're going to have a massive correction like the last two cycles because we never got super overvalued. Do I think it could go down into the 70s? Yeah.
Hey guys, welcome to Everyday Finance. As inflation concerns conflict with poor labor data, the recent decrease in Bitcoin is a reflection of rising economic strain rather than a single reason. The uncertainty around the Federal Reserve's decision to raise interest rates on December 10th adds to the pressure, and the whole situation is becoming more difficult. On the other hand, the slump started in the beginning of October, along with dropping freight volumes, lower housing numbers, and tightening corporate cash flows, all of which signaled an increase in risk aversion during that time period. A steadily improving liquidity backdrop is what may cause a shift in the tide. The Federal Reserve is getting ready to stop reducing its balance sheet in May, to rely on repo injections to quietly reduce financial stress. Additionally, prospective tariff rollbacks and a targeted stimulus plan for 2026 give support for the longer term. Bitcoin is in a position to recover once macroeconomic pressures begin to lessen since, historically speaking, scarce assets have been the ones to profit first when liquidity begins to gradually return.
So, the nice thing about Bitcoin is it's a network, right? It's physically, literally and physically a network. It's a network of nodes that secure a blockchain that enables Bitcoin to be a better form of money going forward. And therefore we can measure all the elements of a network just like any network. And I have a buddy in the industry, Tim Peterson, who runs a firm called N Squared Crypto, and he's N Squared Value on Twitter. And he's been tracking this model, this Metcalfe's Law model, for years. And based on that calculation, he comes up with a fair value of the Bitcoin network, the Bitcoin blockchain network, at around $91,000 or $92,000 today. And what's interesting is if you look at history, in 2017, that value was $10,000. Now, if you remember, we went from $10,000 in November to $20,000 in December. So we got 2 times fair value. And then we had a big correction and we fell well below fair value until the next bull market started. Then in 2021, fair value had gone up to about 33K, but we went all the way up to 69K in November of 21. And then we had a big correction. So here we are in 2025, same 4-year cycle, fair value at 91. We only got up to 125, 126. We didn't get a full 100% higher. We never hit that 170, 180 that people were calling for. And so I will argue that the correction will be more muted because of that. Because, it's likely we fall not just back to fair value, but probably below. Well, why should we fall below? Well, corrections occur when people who bought for, we'll say, less than ideal reasons. Like if you think about the cycle of any investment, when the price is below the fair value, right? And if that's a stock, it's the discounted stream of future cash flows. If that were a bond, it would be the certainty you have with the payment of interest. Whatever it is, if the price is equal to fair value, you're probably agnostic as to whether to buy it or not. If the price is below fair value, investors will buy to try to close that gap. Well, as the price starts to move, traders are drawn to it because traders don't really care about fair value. They just want movement. They want to go long or they want to go short. and they trade. Well, as the price starts to get above fair value, hedgers emerge. Well, what's a hedger? A hedger is someone who owns a commodity, whether it be oil or gold or Bitcoin. Bitcoin's classified as a commodity, that produce it. And they now say, well, wait a minute, if the fair value is here and I can sell it at a price above fair value, well, I know I'm going to produce it tomorrow, so I'll just sell it in the futures market. And if you can sell an asset in the futures market, you need someone to take the opposite side. Those are called speculators. So speculators are taking the opposite side of a hedger. Well, then that increases the price. Now, when the price starts to really get higher above fair value, now the gamblers come in. And the gamblers not only buy the asset because it's moving, but they use leverage. And leverage is not evil in and of itself, but it's the amount of leverage relative to the volatility of an asset. So what happens is, as those gamblers push the price to too high a level, it snaps, they get liquidated, the price starts to fall. And as the price starts to head towards fair value, the traders get nervous, so they sell, and the price gets down. The hedgers can't sell because now the price is below fair value, so they'll just hold it until the price goes back up. And then the long-term investors wait until the price gets down here and they start buying again. So you get this natural cycle. Empathy for the logic of the 4-year cycle being less relevant because we had a step function change in demand. Because at the end of the day, price is determined by buyers and sellers. And if there's, a lack of buyers, then the price needs to come down to meet that demand. If there's a surfeit of buyers, then the price needs to rise to meet the increased demand. So there is some logic to say, well, we have all this new money going into Bitcoin through the ETFs and institutional adoption. But there's one flaw-ish in that logic, which is, remember, every transaction, there's a buyer and a seller. So for there to be excess demand, you would have to have, fewer sellers for price to rise. Meaning, the hedgers aren't producing as much. That's what the halving does, right? The halving intentionally deflates the number of block rewards. And so if I'm a hedger and I own a mining rig and now I only get 2 block rewards instead of 4, my costs are the same. I need the price to rise, so I'm less likely to sell until the price rises, which is part of the genius of the halving in my mind. The difference now is that for every new incremental buyer that we've seen, there's OGs, right? Wallets that have been inactive suddenly selling. And we're like, oh, that's so terrible. No, it's not. Look, if we meaning the community, want there to be billions and billions of Bitcoin owners and users, it can't all be in the hands of a small number of whales, right? Just mathematically. No, you say, oh, but it could, and the new people just get smaller and smaller increments. Sure. I mean, we can divide into 100 million Satoshis per Bitcoin. That's fine. But there are people who have very, very low cost basis who at some price will say, you know what? Yeah, I'll distribute a little bit. And that's what I will argue that looks like to me. There are 2 types of markets. There's an accumulative market where there tends to be more new buyers than sellers. And that makes this accumulation pattern is you can be in an accumulation phase. There's also a distribution phase. And distributive markets have a downward cycle to them. And the basic difference is bull markets and bear markets. Bull markets are cumulative, bear markets are distributive. Raoul and others would say, well, that's because you're wrong. Not me, Mark, but people like me who believe in the 4-year cycle. You're wrong because it was never the halving cycle. I can make a pretty cogent argument why I think it is, but they'll say, no, it was always the liquidity cycle. That doesn't really hold water because the liquidity cycle's 7-ish years, not 4. And the 4-year cycle's been pretty observable for a while. And then look, there's other people that say, and I actually believe this, there are people that say, well, you're only looking at 3 instances. That's not enough. That's fair. That's fair. For statistical analysis, 3 observations is definitely not enough. But because the halving is hard-coded, and because we don't see half the miners go bankrupt every 4 years, and because we do see an upward price movement, I think there's some logic. Now, the second thing, the tailwind, is while all of this other stuff's going on, we can debate back and forth, one thing that isn't stopping is the 6 to 7% devaluation of the currency every single year. And that is the tailwind that will drive the upward trend.
The most recent price action for Solana indicates that its collapse to $130 may have represented a definitive bottom. The swift 25% fall from $173, which was followed by a sharp V-shaped recovery, indicates that momentum is strengthening. The relative strength index RSI has increased from 28 to 50, which indicates that buyers are regaining power as the price moves closer to the crucial neckline of 170. If this neckline is recaptured, it might suggest a wider trend reversal. Reclaiming the 20-day exponential moving average IMA near $160 would further strengthen the argument for a sustained advance toward the $180-$200 range in the near future. On the weekly charts, the $130 level has previously served as a crucial launching point for rallies to $250 and $265.
It's highly likely, Giovanni, that we don't have the same extremes, either up or down, partly because the amount of leverage that people can use has diminished, right? You can't get 100 to 1 anymore. You can get 50 to 1 in some places, and usually it's more like, 4 or 5 times. So if the leverage is less, you won't have the extremes. The reason gold doesn't have as much volatility is it's harder to lever. It's a more mature market. It's much larger, right? It's 10 times bigger than the market of Bitcoin. I mean, gold lost a whole Bitcoin in 2 days the other day, right? I mean, it lost 2.8 trillion in 2 days after going up 10 trillion a year to date. And so the law of large numbers says that you're not going to have the same level of volatility because you can't get the same amount of leverage. There's just not as many people that price. The second thing is gold has been a commodity longer than Bitcoin. And what I mean by that is there's a reason Bitcoin was labeled a commodity, not a security. And it's not a good reason, actually. It's intentional. Anything that's a commodity can be manipulated by the largest players in that commodity through the futures market. Well, that's a process known as spoofing, where the big guys, JP Morgan and Goldman and all these other guys in Europe, they are selling futures to compress the price, and they are day trading around it, which is technically illegal, and they pay fines. This is the crazy part. 2 years ago, JP Morgan paid a $940 million fine, almost $1 billion fine, didn't have to admit any wrongdoing. Commodities and futures markets tend to have this rapid movement. That's a short squeeze. Because when the price is being manipulated, you got all these shorts, they're naked, and somebody starts to buy, whoever that is. This time it was China. China started buying gold. Well, now gold went into a super short covering. So all these guys, JP Morgan, they're having to cover their shorts, and we went from 3,400 to 4,400 instantaneously. Okay, well, now what's happening? Now they're back to shorting again. So now they're not shorting at 3,400, they're shorting at 4,400. And we went from 4,400 all the way back down to 4,000. And so it's that constant process of, spoofing punctuated by these big short covering rallies. And again, this is that distribution. You got the OGs selling into it for the first time, which is good. We want that. We got fewer new buyers. We still have some, but we have fewer new buyers. And we've got the constant downward pressure from the futures market that's kind of capping prices. So, I think we're going to be stuck in a kind of squishy zone for a while. I don't think we're going to have a massive correction like the last two cycles because we never got super overvalued. Do I think it could go down into the 70s? Yeah. Look, I think we're in crypto winter. I do. And I know people don't want me to say it, but I think we're in crypto winter. But I don't think it's going to be severe. I just think it's going to be a more mild winter. If your average is 100, okay, what you have is a savings asset. You don't have a speculative asset, I will argue right now. The chances of making a quick buck on 100,000 from here, I think are pretty low. I think the likelihood that we get to, 500,000 in the next cycle, I think is really high. But that's 4+ years away. So what I think people should do, so I was on TV in 2018. And while I was on the show, literally, and I was on the show for like 6 minutes, but while I was on the show, the price went from 10,000 to 8,000. So it was a big move, right? And the host says, well, what should we do? I'm like, we should buy it. She says, well, you would always say that. And I'm like, yeah, I would. Buy it today, buy it tomorrow, buy it next week, buy it next month. Don't buy it all at once. Figure out how much of your portfolio you want to own. Buy some today, buy some next week, some next month, the month after, and keep accumulating your savings bucket, right? Don't put the money that you need to pay the bills into a volatile asset. Stocks, bonds, anything. I mean, that you need that to be in money that you can spend. But if you want to save your value and protect it from the ravages of inflation, you should be shifting as much of your savings bucket out of fiat into Bitcoin. But you shouldn't do it all at once. You should do it over time.
This move is supported by the activity of the market behind the charts, with Solana demonstrating that futures open interest has increased to become $7.3 billion, that funding rates have remained positive, and that there has been a discernible increase in spot demand. Additional strength is added by renewed ETF inflows of $390 million and increasing on-chain activity, both of which signal that purchasers are gradually returning. When taken as a whole, these signs point to a market that is getting ready for another large increase, which suggests that Solana may be entering the early stages of a broader recovery as liquidity improves across the cryptocurrency sector.